What's up everybody, my name is Wes DeBoer, and in this video I want to go over one of the most important concepts that you really need to understand before investing in the stock market. Now that concept is understanding your investment horizon. One of the biggest mistakes and one of the most surefire ways to lose money in the stock market is to not have a clearly defined strategy. And if you don't know what your investment horizon is, meaning if you don't know if you want to pull out your money in 3 months, 6 months, 9 months, a year, 5 years, 20 years, if you're unsure about that, investing in the stock market is not a great idea. Especially now that the market is completely volatile, the information that we've been getting about the US economy points to the exact inverse of what we think the stock market should be doing. On the other hand, the most consistent way to profit from the stock market is to expand your investment horizon. In general terms, the person who has an investment horizon of 2 to 3 years is going to most likely perform better than the person with the investment horizon of 1 year. And this is because the longer you have your money in the market, the more opportunity you have to catch the long-term upside. The long-term upside basically averages out all the market noise that happens from moment to moment, day to day, week to week. This is one of the few predictions that we can accurately make about the stock market, is that it trends upwards over time. So this leads to the idea of understanding your investment horizon. If you plan to liquidate in 1 year or less, this is an extremely risky for a market that's as volatile as this. Markets can turn around very quickly, as we've seen, and they can put you in a deficit for a long time, especially if you're not dollar cost averaging the dips. Now we know that in the S&P 500, local highs are pretty much always surpassed by the future highs. And this basically implies that if you dollar cost average the S&P 500, there's a very high chance that you're going to end up profitable. And the longer you dollar cost average, the higher the probability is that you will receive the average market return, which is 7%. In other words, the longer you're in the market, the better you'll be. Now, a 10 to 20 year investment horizon is much more powerful than, say, a 1 year, obviously, or a 3 to 5 year investment horizon, even though a 3 to 5 year investment horizon is better than what most people's investment horizon is, especially if you're dollar cost averaging companies that are well researched and that you believe in. There's a few reasons for this, and the common understanding is that there's risks when you put the money when you put money in the market. But there's also risks by not having your money in the market, and that's the opportunity cost that you'll be missing out on. Now, most people think when your money is not in the market, the only risk that you're exposed to is the opportunity cost of capital, but that's actually not true. Inflation is also a big risk of not having your money in the market. So basically, when you don't have your money in the market, you're risking inflation and you're risking opportunity cost of capital. Now, when you have your money in the market, you're risking depreciation of the market value of your assets. And many investors underestimate the importance of capturing not just the opportunity cost of capital, but the inflation. So another reason why having a long-term investment horizon is so powerful is because, now you really got to pay attention to this, because this is really where people make a big killing. When a company pops, and this is virtually unpredictable. So initial investors in companies like Apple, Amazon, Tesla, Microsoft, they believed in these companies when they were young. But look how long an Amazon investor would have had to keep their money invested in Amazon after they went public. And for the amount of time that Amazon didn't experience great growth, the investors who were not invested in Amazon at the beginning were risking not being in on this huge pop of growth that Amazon had. But if you were an initial investor in Amazon, you had to wait a long time. People with small investment horizons, they would have a smaller chance of capturing this pop. And this is where people made all their money, the early investors in Amazon. They had to be invested in this period. So time in the market is extremely valuable because it not only lets you capture the opportunity cost of capital and inflation if you dollar cost average over the long term, it exposes you to the possibility that one of these companies is going to have a significant value pop. So the conclusion is that if you're saving to buy a house in, say, a year, and you're trying to get a 20% return and you have a 1-year investment horizon, you're trying to get a 20% return, that is a very risky strategy, and you're exposing yourself to a lot of volatility. Especially right now, we don't know where the market will be in 1 year. But if you choose companies now and you have at least a 3 to 5 year investment horizon, it'd be awesome if you had a 10 to 20 year investment horizon. If you either just buy on red days or dollar cost average, you're gonna see good returns in at least 3 years. The chances of that are extremely high. So one of the key takeaways from this video is the longer you're in the market, the longer your investment horizon, you'll be able to not only capture inflation, the opportunity cost of capital, especially if you dollar cost average over the long term, but if any of these companies experience a valuation pop in the next 10 to 15 years, you will be ready for it. You'll be able to capture that. And people with smaller investment horizons are not going to be able to capture these big valuation pops. You're not going to need that money for 2 to 3 years, and especially 5 to 10 years. If you invest consistently, even during times of crisis, that's when fortunes are made. Of course, many people don't want to invest for 5-10 years in the future because it's kind of boring. But it is the most tried and true, consistent way to build equity in the stock market. All right, so that's this week's video. Remember to hit the like button, subscribe, and leave a comment below, and let me know what your investment horizon is. All right, thanks. Take care.